thanks participants for keeping for joining on the call. Yeah, Kuldeep, so we request you to take care about the portfolio, what happened the quarter, as well as the short outlook on the what's happening on the economy. So that will help, and then we'll have a Q&A session with you.
Yeah, sure. Thanks. Thanks everyone for joining in. And so on the quarterly update call, the first and the foremost important factor is how the global situation is working out. And if we look the performance of the India market, it had been pretty robust, whether we look for SEBI TD 1 year, 3 year, 5 year. India is one of the best performing markets. For us, crude oil is a key factor. Like we are one of the big importer of the crude oil, and it's a movement to decide like how the current account deficit and to some extent fiscal deficit is getting impacted. Thankfully, it had been largely range bound and stable for quite some time, barring some spike which happen whenever some geopolitical tension get escalated. So net on macro front, we are in relatively comfortable situation. From domestic economy perspective, there had been more of good news, if I have to say so. Like IMF has raised GDP forecast for India by 50 basis points to almost 7%. At the same time, inflation forecast of RBI has come down by 20 basis points to 4.6%. And it's quite important, like inflation had been a key issue or key concern globally in last couple of years. So if it's trending down, it's a good news for India as an economy, as well as overall equity market, if I have to say a generic statement. There had been a downward revision in the fiscal deficit expectation for FY25. Like the expectation is that the fiscal deficit should be close to 4.9%, vis-a-vis say 5.1% in the beginning of interim budget. Current account deficit has also come down. If we think about election outcome, it was relatively underwhelming vis-a-vis the expectation, but good part is like there's continuity, and we believe that whatever the agenda was being set prior to election should continue to take place for next 5 years. And another factor is say monsoon. Like last year they were concerned regarding El Nino, and today we are more or less saying that it's a normal monsoon condition because of the La Nina. And it matters because almost 45% of the labor force is in say agri. And if we think about say rural population, almost 2/3 is the rural population. So net if the La Nina situation is there, monsoon is normal, which is a good news for the rural economy, rural consumption. So the way we think about it from consumption per se, overall from economy per se, we should be in relatively better shape with last year. If we look the various consumption indicator or industrial indicator, it looks like there is a strong traction on ground, whether two-wheeler growth, personal loan growth, IIP, consumer goods, durable, everything is pointing towards say double-digit growth. On the industrial side, air cargo, non-food credit growth, again double-digit. And it's not about say average of first half of calendar year CY24. If we look, the trend had been robust for quite some time. So overall data indicates that about 25 should be a decent year from the economy growth perspective. Outlook, like inflation is coming down. Global growth is resilient so far. Election outcome in India is now more focused on the job creation and the consumption, and everybody will be watching out how the outcome of US election would be, because it may be the key denominator in global policies for years to come. And for overall earning growth perspective in our country, we expect 13 to 15% earning growth for next couple of years. It is in continuation of say robust earning growth what we have seen in last 5 years. Our focus area remains say infra and manufacturing. So if we think about say industrial capex, it was largely led by government and the PSU spending. We expect that the private capex should also pick up. Say focus on defense and the railway overhaul, power, energy transition. Those are the key themes which will continue to do well and well supported by say policy initiatives like PLI, which should also boost the employment opportunity. On the consumption side, the focus is on the bottom of pyramid. At the same time, we believe if the income is higher, it should lead to higher penetration in many under-penetrated categories. Risk is largely global, like there can be a concern related to a spike in the crude oil prices if the geopolitical situation worsen for any reason. From valuation perspective, if we look the Nifty, which is representative of the broader market, the valuation are quite close to say 10-year average. So I will like to believe that for large cap and especially the broader market, the valuation are reasonable and it's well supported by the earning growth as well. For India Vision portfolio, if we look FY24, there have been certain say areas which were underperformer for us, like consumer discretionary, financials, chemicals, and PSU, which drag down the performance in FY24. At certain places, we have taken corrective action. At other places, we believe that the thing should come back. Like in case of consumer discretionary side, we believe there is a large penetration-led opportunity and premiumization-led opportunity, which should help for, say, those categories to do well in years to come. And turnaround is right round the corner. We believe that second half FY25 onwards, we should start getting very good traction on, say, earning delivery part for most of the consumer discretionary companies. And it will reflect on various facets, whether it's a retail, apparel, say alcoholic beverages, or for that matter, if we talk about say footwear, even to some extent jewelry. We think second half FY25 and onward should be quite well for the discretionary categories. So we remain positive about these particular say exposure. Financial exposure, we were having say lower exposure to other PSU banks, etc., which drag down the performance in the FY24. We have taken some position in that particular area about 6-8 months back, and which has done well. Same is the case with overall PSU exposure, like PSU account for almost 10% of the weight. It delivered almost 90% of the return. So wherever required, wherever the white spaces were there, we have tried to take the corrective action and fill in those white spaces in last 8 to 9 months. So if we think about FY25, certain things are doing relatively better. Like in the infrastructure and the engineering space, the names like Polycab, Titagarh, Bharat Electronics, APAR Industries, which are coming from manufacturing, defense, and the capital good exposure, has done relatively better. And we believe this is a direct play on the industrial and the capex activity, and it should continue to do well for years to come. On the staple side, Patanjali Foods, on the telecom side, Bharti Telecom have also done relatively better. So we had taken certain measures in last 6 to 9 months. Some of them have yielded a decent return, and rest should also follow in due course of time. These are the actions being done in last, say, 4-5 months. So APAR Industries, Adani Port, Titagarh was taken about 4-5 months back. And then in last 3 months, we have taken position in Gravita, KA Industries, Ramkrishna Forging, Transformer Rectifier. We have brought down our financial exposure, namely like AU Finance Bank and Bajaj Finserv, as well as some consumer name like Bajaj Paints and the Page Industries. So if we discuss about, say, new entries like Ramkrishna Forging, it came about, say, 3 months back. And in case of Ramkrishna Forging, this company is expanding its play. Earlier, it used to be only proxy play on the domestic MSCV cycle, but today it's trying to increase the exposure towards the non-auto side, and we expect that the revenue contribution of the non-auto business should increase from 23% to almost 30% in next couple of years' time. This company has done many bolt-on acquisitions, and currently they may be subscale, but in a year or two, most of them should have a decent output in combination with the margin expansion led by, say, operating leverage, which should lead to a better consolidated operating performance for Ramkrishna Forging. This company is also having JV with Titagarh Wagon, where it has won almost 12,000 crore, say, Indian Railways order to provide the forge wheel for next 20 years. So net, this company is diversifying into multiple areas, which should add to multiple revenue stream for many years. And that's why we are quite confident the company can deliver almost 25 to 30% earning growth for next 2-3 years. Even following that, there should be robust earning growth. Gravita India is a leading player in the circular economy system. And today, if we look globally, this is a central theme for, say, many economy or policymakers. So it may be led by, say, ESG goal of different companies, but this is a theme which is going to have a multi-decade tailwind. The company is currently having capacity of close to 250,000 ton, and which is expected to increase to almost 4 lakh ton in next 2 years. And this company is having presence both in India as well as in Africa, and which help to serve, say, global market as well as emerge as like India MNC over there. Overall, we expect that this particular, say, recycling sector or circular economy sector should grow in double digit overall, and there should be unorganized to organized transition, which should lead to almost 20-25% revenue growth for this company for many years to come. And there is a scope for some margin expansion as well, which should lead to almost 25% plus earning growth for the company overall. This company is diversifying from, say, existing line of business like whether it's lead, aluminum, as well as getting into other, say, line of businesses like plastic, lithium, and many more may come in due course of time because there's a strong policy tailwind, if I have to say so. Transformer and rectifier, in our view, this cycle of, say, transformers have just begun, and it may continue for at least another 5 to 7 years. And this is among the top, Trail is among the top 3 players over there, having an order book of almost 3,000 crore as of June 2024. And they will be a step jump as far as the earning growth delivery is being concerned. Like there should be almost 3x profit in FY25, and it should continue for at least 3-4 years, where we will be seeing that more than 40-50% CAGR for another 3-4 years. So history is not representative of the future which this company is undergoing, and that's why we are quite hopeful that the fundamental performance of this company should be quite strong for many years to come. Sorry. KI industry, like we already had our exposure of polycab for quite some time. We decided to add further exposure in the cable and wire space. So KI industry is number 2 player with a strong track record of almost mid-teen revenue growth and slightly higher earning growth for almost a decade. We expect next decade should be even better, like the top line growth itself can be in high teen, as well earning growth can be even higher. So there is a consistency both on revenue and the, say, profitability part. And this is the piece where there is a strong tailwind both from industrial capex side as well as the residential capex side. BHL is another, say, name which we have added in last 3 years, which is going through turnaround. Like the profitability in the BHL should also improve multifold in next couple of years. So almost from 280 crore in FY24, we expect, say, in next couple of years, the profitability can be almost 10x. So these are the additions which have been done in last 3 months over there. If we look the India vision or GDF positioning over a period of time, so this particular, say, slide depicts that how this particular portfolio is evolving over a period of time. Say 4-5 years back, it was more about financial and consumption. They put together used to account for almost 85% of the portfolio. Over a period of time, a lot of diversification has happened, and today the representation is there from most of the main sector within the country. And today, infrastructure and engineering will be almost 1/3 of the portfolio. Financial and consumption would be another 1/3, and rest of the sector, whether automobile, utilities, energy, healthcare, etc., make the balance 1/3 over there. So a decent diversification is being done, particularly in last 6 months or so, and we should yield, say, more stable and predictable performance for, say, time to come. This is psychographic, like infrastructure and engineering is almost a 1/3 of the portfolio. As I mentioned, financial and consumption put together is another 1/3, and rest of the, say, sectors would be providing for 1/3, balance 1/3 of the, say, exposure. From market cap perspective, almost 50% plus is large cap, balance is in mid and small cap. So we have tried to have balanced exposure towards across the market cap categories over there. If we look the, say, operating performance delivery, so if we look the portfolio companies put together, they had been consistent earning growth in last 5 years, like almost 25-26% earning CAGR, vis-a-vis, say, Nifty CAGR of last 15-16 years, then 15-16%, and it should continue for FY25 and for even coming years. Like in FY25, we expect almost 25% plus earning growth, and same should continue in FY26. So, which is a significant delta with the Nifty over there. We look the valuation perspective, as we have said in past, that stock return, portfolio return are combination of two things, like what is happening to earning growth and what is happening to the valuation. So earning growth was not a challenge, like portfolio overall was delivering quite decent earning growth, but there had been a multiple derating which happened in last 2.5 years, which led to relatively subpar return. And we believe today the valuation are quite close to the trough, like valuation are quite close to the bottom being experienced at any major crisis in last 4-5 years. So theoretically, if the valuation is stabilized at the current level, then a large part of the earning growth should translate into the stock return. That is the basic, say, premises over which we are working. Like companies have delivered the earnings in past, delivering now, and should continue to deliver in years to come. In last 2.5 years, they had been derating, so we couldn't realize full benefit of the earning growth. And today the valuation are quite close to a level from where the probability that it's coming down further look relatively lower. And in fact, if we think about, say, a style perspective, say, growth as a style should come back with the interest rate cut. And in those scenarios, say, overall equity should benefit, as well as the companies which are positioned in high quality, high growth area should also benefit. So we have tried to say reduce the gap in as far as the performance being concerned. And as I mentioned that we have done multiple changes in last 6 months, and some of them have yielded a decent return, like whether it's a Titagarh, whether it's say REC and Gravita. And we believe there is potential in those names, as well as the other changes should also yield the good return in time to come. This is the summary of, say, stocks which have done good in last 3 months or 1 year. So, Titagarh, Bharat Electronics, REC, Polycab have done quite well in last 3 months. In a longer time frame, the names are like whether it's Bharat Electronics, Titagarh, Bharti, Polycab, and Indian Oil. Some of the names have been dragged in the portfolio. So we have exited AU Finance Bank. We have lowered our position in Naveen Fluorine. And we believe in case of APL, Apollo, and Bajaj Finance, the things should come back reasonably well, because in case of APL Apollo, there is going to be a very strong second half and quite a strong performance in FY26 and beyond, which should help the stock performance. In case of Bajaj Finance, earning growth was not a challenge. The company is delivering 25% plus PPOP growth and a significant outperformer. As I mentioned, that the high quality, high growth piece is something, and that too in BFSI, where a strong derating happened. And today the multiples have come down materially. and we are quite confident about the earning growth delivery part. So once the de-rating piece materialize, we believe that earnings should translate into the stock return, and that's the reason we continue to hold APL Apollo and Bajaj Finance. We have exited, say, AUI Small Finance Bank, and we have trimmed our position significantly in Naveen Flooring. I will stop over here and happy to have any question you might be having.
Thanks, Kuldeep, for giving the combination of the new stocks entry also. What was the reason to buy? At the same time, the how the valuations were there in the 2021 and now currently, which actually shows more lucrative to the long-term perspective. Participants, I request all the people who have a question would like to ask to Kuldeep, put it in the chat box so that all the questions we will accurately to Kuldeep and then we'll get the answer from that. We can keep on questions can keep in the chat box and Q&A box so that we can have the questions to them. Yeah, Kuldeep, before the participants asking the questions, there are some questions which are commonly asking the in terms of the point. So one, seen the market conditions today. I think all the wherever the markets has been all-time high. So can you just help the clients also on that? How the in terms of what was actually driving the market? So is it a sustainable, and is it a good time to add the money into our portfolio? Because this is a common question which is coming into that. So how it help the customers in this market? Is it a good time, or should we wait? Is any valuations concern in the at the currently as seen the rally?
So I tried to address this particular thing during the presentation itself. Like if we look last 30 years, so generally say stock return and the earning growth go hand in hand. Like last 30-year earning growth will be close to 12%, and similar should be say overall market return. If we look last 5 years from FY19 till FY24, the earning growth accelerated significantly vis-a-vis say previous 10 years. So if we look FY08 to almost FY19, almost 10-year period, there was hardly 5-6% growth, and the market return were also high single digit. In last 5 years, we have seen that the earning growth is almost 15% plus CAGR, in fact higher. And this is something which is driving the market. Like a lot has changed on ground, and it's happening across the pockets, whether large cap, mid cap, small cap. So predictability quotient has gone up, and we expect that FY25 and FY26 should not be very different vis-a-vis the last 5 years. So at the overall market level, we expect almost 13 to 15% earning CAGR. And for our own portfolio companies, we expect that more than 25% earning CAGR if we exclude the OMCs over there. So that way, say earning growth support and the predictability quotient is relatively very high. And in the scenario like that, at times, say market may move up, there may be some mild correction, then there can be some consolidation. But as long as say market movement is driven by say delivery on ground, say material correction may be a difficult part if I have to say so. And second part, say financial discipline and equity awareness have also increased in last 4-5 years. So earlier, equity used to be very small factor in the overall financial saving and say overall household asset exposure. It's changing along with say many new generation say investors have come who are quite relatively savvy, as well as the discipline has also come, which is quite evident in the form of SIP, like they are close to the lifetime high. It suggests that the people are coming with the long-term perspective and doing the systematic investment in the overall market. So the key denominator is like earning growth had been resilient and should be resilient. In between, there can be some up and down, but from as long as the domestic factors are being concerned, they are very conducive. As I mentioned earlier, that the only factor which may play a spoil sport, it can be some global risk related to some geopolitical situation. But we have seen like those risk also. It can be, say, a pause in between rather than derailing the overall story. Like in last 4 or 5 years, we have seen all sort of challenges. Like 2018, we were having some concern related to trade war, then ILFS, and 2020 we had say COVID-1, next year COVID-2, then Russia, Ukraine, now Israel, Hamas, and so on. So challenges are coming every year. But the point I'm trying to highlight, as long as the economy is resilient, as long as the numbers are coming, earnings are coming, stock market will respond to that. And in those scenarios, if some material correction happen, it should be a buying opportunity because from fundamental perspective, we are quite optimistic. Like India as an economy should do quite well for next 5 to 10 years. And honestly speaking, in last 8 9 months, we have tried to align the portfolios in the areas where the future look quite bright, like whether it's infra, capex, manufacturing, capital goods, etc. We don't believe that it's a year one, year two story. It's more like a decade story at least, and we have tried to reposition the portfolio in that direction.
Thanks, Kuldeep. That helps the basic, which is common question. Kuldeep, just wanted to understand in your portfolio that the recently whatever we added like stocks like Gravita, the Titagra, the Bharat Electronics has performed very well, which is more than in between 30% to 60% of the stocks has been rallied in the last 3 months. So the question which is coming, the good that you picked a very good stocks, but are you continuing these stocks? Are any valuations concerned because of the sharp spike in these companies? Is it what's happening on those stocks? So is it buying a long-term to holding, or for the fresh customers also are you going to add? So that's where it is coming.
So look, if we look any of the companies which we have added, I said it's not a 1 year story or say 2 year story. It's more like a 5 to 10 year story which we are playing. So Gravita, as you mentioned, this circular economy actually has started getting some foothold and a long way to go. If you are going through, say, different news articles, say government's own initiative, etc. Every sector they want to have sustainable growth. So ESG has become a key criteria for many, say, corporates as of now, and probably the momentum can only pick up, and our confidence in the probability that these companies will deliver is going to further increase in time to come. So Gravita, as I mentioned, that this company should deliver 20 to 25% revenue growth and at least 25 to 30% earning CAGR for next 5 years at least. And it's not restricted to India. Large part of the Gravita revenue come from, say, rest of the world. Like they have the operation in Africa, they are exporting, say, European countries and so on. So it's like India MNC in making, and opportunities are available across the world. So we are quite confident that this model will be having policy tailwind not only in India but the global policy tailwind. So the stock has moved quite fast, then there is some correction and the consolidation. But net, we do believe this story is going to have the legs.
Excellent. So these are all the high growth stories for the long term point. So you can hold it for mind. Yeah. So basically, as we have a contributors, there are also some detractors which has been laggards in the portfolio, especially the Navin Florin. We've been holding for so long, and you have also mentioned that we've been adding some of the weightages in that. So, can you just give us these four laggards which has been the portfolio? One is Sai Silks, one is Bajaj Finance, and the APL Apollo. If you look at those companies, earnings also not encouraging in the last 2 quarters, or some of the one of the quarters, except Bajaj Finance. So, what is that rationale to be hold for so long? What actually giving a conviction to be there in the portfolio for these stocks?
So again, I tried to answer this question during the course of presentation. So I mentioned that Bajaj Finance case, they had been consistent top line growth and the bottom line growth. And there had been sharp derating which happened in the overall financial services space, whether it's a private bank or for that matter NBFCs. And this is something also reflected in case of Bajaj Finance. But valuation derating is also having a limit. Like if valuation has already come down, say 40%, 50%, at some point of time it will stabilize. The companies who can consistently deliver, say, earning growth or say bottom line growth, at some point of time that earning growth has to translate into the stock return. It has to happen whether now or 3 months down the line, because there can be underperformance for two reasons. Like one, the company is not delivering on ground, and that's the reason the stock market is responding. And second is like when the earning growth is there, and for whatever reason, say multiple derating is happening. So second situation is relatively to be better situation to be in, where there is a strong support of the fundamental, and we are just waiting for multiples to stabilize, and which should be followed by, say, earning translation into the stock return. APL Apollo, I already mentioned that Q1 was relatively challenging, like 9% volume growth and yet muted operating profit growth, because operating profit per ton was relatively lower. Q2 may be also on the similar line, but from overall year perspective, we still remain quite hopeful that the company can deliver almost 15-20% overall earning growth, and followed by almost 25% plus earning growth for next couple of years. So what we are going through is a near-term pain in the operating performance side. On second half of the current financial year and onward should deliver better outcome as far as the operating side is being concerned. And that's the reason we are hopeful that in any journey there can be some hiccup, and probably we are going through that pause or hiccup as we speak. But otherwise, it's a leader in its own space, almost 50% market share. And again, this particular sector is having strong infra tailwind. So we are quite positive over there. Third piece I mentioned about Navin Foreign, like though they are structural tailwind available in that particular sector because of multiple reasons, whether it's China plus one, Europe plus one, but the pain had been relatively longer than expectation. So over a period of time, we have brought down our exposure in the chemical sector dramatically. Like we have exited SRS, and we have brought down or trimmed our position say, of Navin Fluorine materially. So we have done that particular part. Fourth is the size silk. Size silk is relatively smaller exposure in the overall portfolio, like 1% weight. And the situation had been quite similar across many consumer discretionary categories from say second half FY24 onwards. There was a macro challenge across most of the consumer discretionary categories, and same reflected in the operating performance of say size silk as well. And particularly somebody is having say more wedding related exposure. So the same was the case with Maneuver, same was the case with even for Titan, Senko, and the same was the case with for Side Silk as well. Like there was almost negligible wedding days in Q1 FY24, FY25, vis-a-vis say a relatively high number of days in Q1 FY24. We believe in Q2 FY25 itself, the performance should start coming back. Because there are relatively high wedding days in Q2 FY25, and second half should be again quite superior because company is doing almost 90,000 square feet say area addition on the base of close to 6.5 lakh square feet. So I will like to believe the worst is behind for that particular company, and it's a small cap. So whenever there's some operating underperformance, there can be pressure on the stock performance as well. And reverse can also be true. So we have seen just prior to the Q1 result, the stock was in extreme pressure, and with relatively better commentary during the Q1 call, some rebound has happened. And as and when the delivery of earnings should start coming on ground, whether it's Q2 or say coming quarters, stock should respond over there.
Got it. I think you have mentioned in the presentation. Now I think it is a little bit more detail on the things which is helping that. Yeah. Now it's majorly the performance related queries are coming. I think you have mentioned it. The portfolio, the three reasons which was been majorly of the exposure of consumer discretionary and not being the PSUs and these some of the NBFC stocks also. But if you look at that 1 year and the 3 year performance between the BSE benchmark, the gap has about it's not widening, but I can say that still it is a very huge gap is there. So understood. The question which is coming is because of the PSUs are not there, because of the consumer discretionary as part of there. But how are you looking for the going forward? That is more important. Is that gap? How soon we can expect that reduce the happen? Because one side the benchmark is doing good, rather than moving away that side. Well, can we stay here for the so long? How basically they wanted to understand about is how quickly we can see that gap come down from the benchmark and the performance of the portfolio.
So, as I mentioned, like there was some sort of misalignment in a sense, like there were certain pockets where a lot of action was happening, and we have relatively underexposure in those areas. So we have tried to correct that particular part. Today, we have tried to address most of the white spaces, and earning growth was not that big a challenge. It's more about the composition of the overall portfolio. And many changes are being done in last 3 to 6 months. Some of them have started yielding decent return. And rest of the position, because either we have built or building, we think the divergence should not be as big, or say the way we have seen in last 1 year or 2 year. So we believe that both on say portfolio action on our part and delivery on company's part, both are getting aligned, and probably relatively better time in coming quarters or years.
Understood. So as rate the same side is asking that the team of the ASK, is it a delay in the picking of the right segment of the infra and manufacturing of the stocks? Are you feeling there is a delay in the entry is in that segment? Are you
So
coincide that?
I would say there were certain changes which were done even 8 9 months back. So whether it had been say Bharat Electronics or for that matter like REC etc., they have done well. But I would say when you are going through a delta shift, at times probably you would take relatively smaller steps, because it had been almost 2 2.5 years since which this quality growth theme has not worked. The reason had been quite evident to more or less everyone that when the interest rate are rising, which was the case from September 21 till almost say March 23, and post March 23, the interest rate had been stable but at higher level. When the interest rates are higher, it's not a good news for say growth sectors and the growth companies, because a large part of the value hinges on say terminal, say 10-year hands, 15-year hands. And this is what has happened. Like anybody practicing growth style had more or less similar situation. And today, as we speak, the expectation is that the first Fed rate cut should happen in September itself. And the direction is also quite clear if we go by, say Fed chairman over there, that probably we are already past the peak interest regime and the interest rate cuts are offing. And next 1 year, probably the interest rate should be materially lower. Whenever it will happen, it's a good news for say growth economy, growth sectors, and the growth stock. So the way I would summarize, whatever had been say macro or headwind for us in terms of higher interest rate for our style, probably it should change and it should convert into the tailwind for in coming quarters in a coming year. So as a style, probably the growth and quality should come back, and we should be able to say make up for some of the lost ground.
If you look at the portfolio, the question overall exposure, the engineering segment is in a very high level exposure, which is about nearly about 18%. Okay. As you mentioned, some of the stocks like Ramakrishna Forgings and everything will come that. So the sector of the engineering particular segment, can you give that 4 to 5 points what actually giving any conviction to have a higher weightages? I think the second is about NBFCs we are having, but what will the conviction that have engineering of the weightages?
So Ramakrishna Forging, Gravita, Trail, I explained most of the say recent
Stocks you have
addition
explained,
and the
yes.
rationale for the same.
But on the
So
overall sector point of view, how it is looking, because the engineering sector, that's what the customer want to like to understand.
So again, now I mentioned one thing. If you look last 2 to 3 years, most of the capex story in India was driven by the government capex. And the way we think about it, like coming years, it will be led by the private capex. So that's the reason whether it's a Ramakrishna Forging or say Trail, etc., should start having say much more traction for many years to come. And they are at the cusp from where probably the stronger part of the journey will start. Like transformer sector may have done relatively okay, but best part has yet to come. So as on now, say about 24 March end, their order book was close to 2,500 crore. As on June, it was close to 3,000 crore. We will like to believe that year end it should be close to 3,500 crore or so. Full year basis, we expect that company should deliver almost 150 plus crore profit. Whereas last year it was only 40 crore. In about 26, this number may be close to 300 plus. So we are talking about multi-fold jump in the profitability of whether it's a trail. Similar is the case with BHL. So the profitability part should have material shift for many of these companies and for many years to come. So it's not about a year or two. It's about the decade where this particular theme should continue to have a very strong traction. Like if you look the manufacturing as a proportion of GDP, I think it used to be 14-15% say till last year or so. And this contribution will increase to almost 20-25%, if not 5 year, then probably 7 year, but it has to increase significantly. The way the government is having a focus, the way the things are changing on ground. So quite confident that this particular piece of infra, the capital good manufacturing, everything should fire for many years to come.
Thanks, Kuldeep. Kuldeep, in the sectors wise, if you look at in the banking and NBFC sector, so I think in the private banking segment, we are almost I think nil, okay, in terms of the exposure and that thing. So is it in terms of they have a negative outlook on the banking segment, and how in terms of they would like to understand the both banks and NBFC sector are the view on that.
So we moved away from HDFC Bank to SBI Bank quite some time back. We added the REC as well. And on the NBFC part, we have Chola and Bajaj Finance. Chola has done well. Same is the case with the REC. So what we have done, like many of these PSU bank, etc., and for that matter, REC, are going to have a decent earning growth delivery. At the same time, the valuation are a lot more reasonable. That was the basic premise to move in this particular domain. So from overall financial sector exposure perspective, we brought down it materially because we had to take some weight out from this particular sector to deploy the same in the infrastructure manufacturing area. At the same time, the enabler of the same, like REC is the enabler of say power story in this country. So wherever they are the structural region for growth for many years to come again, and that too at a reasonable valuation, we have taken that particular exposure. So if we look about private banks, one thing is happening over there. There is certain loan growth, but there is some NIM pressure because the cost of fund has increased. And that's the reason NII growth is relatively lower than the loan growth. And there is some say pain on the provisioning part. You can say like it's getting normalized after relatively lower credit cost period of last 2-3 years. That's the reason profitability growth is relatively lower than say top line growth in this particular domain. So overall, private banks can deliver low teen sort of number, and we decided to move in an area where the earnings are relatively better and that too at a relatively lower valuation. That's the reason for the shift and also for the reason to bring down the overall exposure in this particular item.
Thanks, Kuldeep. That helps. Participants, so there's a couple of questions are there, but we keep on chatting on the box in the Q&A and chat box. So it will help us to just give that to Kuldeep from this part on this. Yeah, Kuldeep, yeah. So one of the again performance score is coming. So the Golden Decade Fund, okay, which has been invested for the almost 2 years, it is in a illicit returns are there lower than mutual funds, relatively. Okay, how to in terms of the reading, because I think it's been answer you are already covered. What is your in the long term perspective, which you're given the conviction on that? So you would like to add top up on that query to them in a to give a conviction to this guy.
So, as I mentioned, Vision and Golden Decade portfolio are same, and the challenges which we faced for last couple of years are also highlighted the same, whether it's more to do with the style part or say our under exposure in certain areas. So those issues are being addressed, and uh, we believe the valuations are quite conducive and earning is not a challenge. So we remain quite hopeful that going forward, the strong earning growth conversion should also translate into the decent stock return for say coming years or so. So it's more about the reason of the confidence is that if the fundamental piece is missing, like earning is not coming, then obviously we will be a worrying lot. But if you look last 1 year, last 5 year for coming years as well, earning was not a challenge. It's more multiples coming down for different reasons, like whether it's interest rate leading to some concern and the growth style overall suffering over there. And today we are talking about just reverse the situation that interest coming down, helping and being more conducive for that particular style. Valuation already quite close to the level of what is probably a trough being experienced in the last 4 or 5 years. Uh, I think a decent part of the earning growth should convert into the stock return for years to come now.
I think that sounds good. I think the overall performance point of view is with the de-rating, whatever happened. So I think going forwards, which is the where key, the interest rate cut as well as the earning growth expansion has to catch up with the returns. This all will help to catch up the whatever the gap is there. Now, I think a couple of last two questions which are all there here. Would like to put it to you. What are the key risks which are foreseeing in the next couple of might be in the 1 or 2 years in the equity market perspective? If the risk you have been foreseeing, how you are able to uh, mitigate the risk in that if you have been expecting?
So again, I tried to highlight this particular part, like from our own economy per se, we believe we are in very good shape. The risk may be more related to, say, external risk, like if a geopolitical situation worsen to the extent that it lead to a flare up of, say, crude oil, then it's having implication for our own economy. So it's more external risk, and we have seen many gyrations, like many extreme events in last 3 4 years, and crude oil also had a journey from one point to another. And so there can be a short-term risk, like all of a sudden crude oil spike having implication for our own balance of, say, BOP position or say current account deficit position and so on. But net, if we think about 3 year, 5 year perspective, I do not think that there is any major challenge from, say, our own economy growth perspective or companies' ability to deliver earning growth over there.
That sounds great. I think. Participants, I think we have come to the end of the quarterly update session. I request all the people, whoever have any questions and everything, you can send it to the respective RM. We can get it from the Kuldeep those answers also. Thanks, Kuldeep, I think for participating on this quarterly update on the tax participants and things. So we'll again meet on the next quarterly update with the Kuldeep on the same India Vision and Golden Decade Fund. So with this, we would like to conclude the session.
Sure. Thanks. Have a good day, everyone.
Thank you.